Partners. Michael, it's great to see you. You don't have a view on the dollar amidst all of this, do you? Strong, weak? I mean, that's just the tail on the dog, right?
Yeah, I think it is, Kelly. I mean, look, what we have to worry about is if there's some kind of drastic movement that imparts a business cycle shock. And it doesn't look like, that's a cheap threat at the moment to me.
Right. So in other words, if we all of a sudden had a crisis and a super strong dollar, something to that effect. OK, let's dive in. We heard some anecdotes from Steve's reporting, even from this discussion about the 10-year, Michael. I mean, you're sticking with this idea that the slowdown is coming. Why?
Yeah, I think the data points in that direction. I mean, look, credit where credit is due. We have been in a soft landing essentially for the last year. So the economy has outperformed expectations. The S&P 500 has just been on an absolute tear. So, credit to the bulls. The question is, where do we go from here? And what we're starting to see is signs of a late cycle environment where growth begins to slip below trend. And that's what you tend to see just before a recession starts. Now, maybe it's different this time. Maybe the data is distorted. Maybe we'll see big revisions in the future. But we have the unemployment rate up 0.6 from the cycle lows. And if you go back through history, you don't see a movement like that unless you're in the tail end of a business cycle expansion or early innings of a recession.
Got it.
Now,
Luke, just quickly to put a pin on that, because some are watching for the SOM rule to be triggered, which is when the unemployment rate's up 0.5 point on a three-month moving average. But you're saying, look, we're up 0.6 I think year on year from the lows, and regardless, that's not a great sign. And can you just explain? I mean, I do find it quite amazing and astonishing for all the liquidity that's been sucked out of the system. We've watched the M2 levels and so forth. Why is the economy, and NGDP is fairly strong still. I mean, real GDP 1%, okay, but even NGDP has been fairly strong. What do you make of that?
Pretty strong. So, I mean, I think that all speaks to an environment where the neutral interest rate has been much higher in this cycle than it was in the last cycle. And so the last cycle after the financial crisis with a lot of deleveraging pressures, I mean, we had all we could do. The Fed had all it could do to keep the business cycle going. And it's been just the opposite with a super rapid V-shaped recovery and high inflation and households having this big buildup of excess savings, which is essentially gone now. So in that environment, the neutral interest rate's higher. That means the Fed has to do more to slow the economy down. And so the rate hikes that they did, even though it was historic, you got to go back 4 decades to see a movement like that in policy rates, has succeeded in slowing growth. Nominal growth is slowing. Inflation is coming down, although, we had a few disappointing months. But we didn't see the bottom fall out of the economy or some kind of epic, sudden crash. So the neutral interest rate has been higher. The question going forward is, can the Fed thread the needle here? I mean, obviously, the risk is that if they wait too long to start easing, then you have a recession. And if they ease too soon or by too much, then there's an inflationary mess to clean up on the other side. There is a super high, maybe epic and historic level of confidence that the Fed is going to get this just right because the last year has essentially been a soft landing. And, history shouldn't give us that much confidence in that regard.
Sure. Steve, do you want to jump in here?
Well, I think what's interesting here is I kind of agree with Mike in the sense, and I don't know if he would agree with this characterization of it, but I'm a technical cutter, which is also sort of an insurance cutter. I think the Fed can take some off the top and still be restrictive. Whatever new neutral rate Mike was talking about, it isn't 540. I think that's pretty clear. And I think that if you do have concern, and I think Mike's point about the unemployment rate is a good one. I mean, it is worth pointing out this economy has outrun the inverted yield curve rule, and it might yet outrun the SAM rule, too. I don't know for sure, but it could. In any event, it's something worth noting that the unemployment rate has gone like this, and the inflation rate's gone like that. Look, what's really interesting to me, I love Mike's comment on this, if you don't mind, Kelly.
Yeah, please.
Is the Fed forecast core PCE for this year at 2.6%. It is now 2.75. Why is all of our hair, such as it remains, on fire over 0.15 miss on the year-end forecast, Mike?
Yeah, great point, Steve. Look, I think the reason for that is that we had a 10-quarter inflation overshoot. So for temporary and transitory, that's, quite a long period of time. And so I think because of that forecast error, the Fed is reluctant to get going here in terms of, I think what you described is like a mid-cycle adjustment, right? Where the policy rate is deemed to be restrictive. I think we can make that case. And so, why not have the Fed be preemptive and forward-looking and get out there in front and make an adjustment and then hopefully preserve the business cycle? That's much easier to do if you haven't already had a 2.5-year inflation overshoot. And so, that really, puts us, I think, unfortunately,
I just wouldn't, Mike, I just wouldn't